During the span of my career as a mortgage broker, I've had mixed feelings about reverse mortgages. Reverse mortgages can be an excellent tool for some and allow retirees a better financial quality of life. There are clear advantages to being able to continue to live in the home you own further into your retirement, such as maintaining your independence and staying close to your community. The psychological benefits of this alone can improve both mental and physical health, but what has really changed my opinion about reverse mortgages is not necessarily the product itself, but rising home values. Let me explain. When reverse mortgages first came onto the market values of homes in Canada compared with the cost of living was much less than it is today. For example, 10 years ago, the average home price in Canada was under $200,000. However, recently the Canadian Real Estate Association announced that the average home price in Canada is now over $700,000. During the past 10 years, the cost of living, not including real estate, has risen, but not nearly by the amount home prices have increased. Due to this massive increase in home values compared with the cost of living, homeowners over 55 who own their own homes mortgage-free now have access to a larger total sum of money with reverse mortgages due to the larger amount of equity in the home. This larger sum of money will last reverse mortgage borrowers many more years into the future compared with if they had taken out a reverse mortgage in the past. For example, let's say your home was worth $300,000 10 years ago. This would have allowed you access to a reverse mortgage of $165,000. Now, let's say the home is worth $700,000. This would allow you access to $385,000 in reverse mortgage money, over double the amount from 10 years ago. My concern in the past when home values were lower than they are now had to do with how quickly the borrower would run out of money due to the smaller loan size. This is no longer as much of a factor, but regardless, a reverse mortgage still requires planning. Now, let me explain a little bit about how reverse mortgages work, and then I'll discuss the differences between the two lenders in Canada currently offering them. Some common misconceptions are that you will owe more money than your home is worth in the end, which is untrue. That failure to make payments can result in eviction. Since you do not make payments on a reverse mortgage, this is also untrue. Another is that you will not be able to pass on your home to your children, which is untrue as well. Once you're finished watching this video, I encourage you to reach out to me if you have any questions, because having a complete understanding of any mortgage that you may be considering is extremely important. Now, let me explain a little bit more about how reverse mortgages work. A reverse mortgage in Canada allows Canadians over the age of 55 to borrow up to 55% of the market value of their home. Unlike a traditional mortgage that is paid down over time, a reverse mortgage requires no principal and interest payments because interest accrues on the amount owing, and the amount owing grows with time. Reverse mortgages are equity-based lending rather than the traditional method of qualifying mortgages using income and credit history. This means that income is not a factor in the qualifying process. The reason income is not a factor is because those seeking a reverse mortgage normally are doing so to compensate for lack of income. Otherwise, if you earn enough income to qualify, a home equity line of credit would be a better solution due to the lower interest rates offered on home equity lines of credit. So make sure you speak with a mortgage broker before applying for a reverse mortgage so that the broker is able to determine if the reverse mortgage is the most cost-effective solution for you. After all, the amount of interest charged will have an impact on your financial future. Credit history and FICO scores are not a major concern for reverse mortgage lenders because the borrower is not making payments on the mortgage, so the lenders do not need to be concerned about the mortgage going into default. When you take a reverse mortgage, you retain ownership of your home, so the reverse mortgage can be paid out should you sell your home or have the desire and ability to pay off what is owing. With a reverse mortgage, the amount that you are required to pay when the mortgage is broken from the sale of your home will not exceed the market value of your home. So if what is owed exceeds the sale price of your home, the lender will cover the difference. With a reverse mortgage, you are able to take the money in one advance, so the entire amount all at once, or you can receive advances in reoccurring advances over the years. These reoccurring advances are normally required to be a minimum of $25,000. Interest charged on a reverse mortgage is based on the balance of the mortgage rather than the approved amount. So it's best to borrow in amounts that you feel you need rather than one lump sum amount. Unless, of course, you're able to invest the funds in an investment that provides a greater percentage of return compared with the mortgage rate, or you require the full amount for your own purposes. Unlike most traditional mortgage lenders, reverse mortgage lenders permit the use of a power of attorney if one of the borrowers is unable to sign for the mortgage due to medical reasons. Power of attorney cannot be used if one borrower is simply not in the country. A real estate lawyer is required to register a reverse mortgage and provide independent advice. The real estate lawyer is chosen by the borrower and also works on behalf of the borrower to ensure that they understand the legal obligations of the product. Use of the reverse mortgage funds is completely up to the borrower, so you do not need to explain the purpose of the funds and are free to spend it as you wish. For example, one clever use of the funds could be to renovate your home to install a rental unit in your home, which could provide you with additional income during retirement. There are currently 2 reverse mortgage lenders in Canada, although I suspect that we'll see more in the future. Most people are familiar with the home equity bank CHIP reverse mortgage, which has dominated the reverse mortgage market for years, but recently Equitable Bank has launched their own reverse mortgage product. This is great considering that with any product on the market, whether it be a physical product or a financial instrument like a mortgage, competition tends to lead to lower pricing, which we're now seeing. Overall, the setup fees are about the same with both of these lenders, but at the time of releasing this video, Equitable Bank's reverse mortgages come with lower rates, especially if you choose to limit the amount of the mortgage to 40% of the market value of your home rather than 55%. However, Equitable Bank's rates at 55% loan to value are still currently lower than Home Equity Bank's CHIP reverse mortgage. So what is the best course of action to take if you are considering a reverse mortgage? Contact a licensed mortgage broker like myself for advice rather than just contact the reverse mortgage lender directly. The mortgage broker will be able to compare the rates and pricing for you and provide you with non-biased advice. A mortgage broker is paid by the lender, so their advice is free of charge, and just like with traditional mortgages, brokers and agents will use their expertise to save you money and place you with the right lender for you. Well, I hope this was informative. If you have any questions, please don't hesitate to contact me directly through my website or leave a comment below. Thanks for watching.